Hello, I'm John A.G., and I want to start with a feeling most people don't know how to name. It's that quiet moment when something you trusted still looks stable, still looks familiar, but no longer feels solid when you step on it. Nothing has visibly broken yet. The lights are on, the numbers still update, the headlines still sound normal. But underneath that surface, something has shifted, and your instincts are trying to warn you before your logic catches up. That feeling is where we need to begin, because the silver market right now lives entirely in that space between appearance and reality. Most people think markets move because of news, or inflation data, or interest rate decisions. They believe prices fall because sellers outnumber buyers, and prices rise because demand increases. That story is comforting because it suggests order, fairness, and predictability. It implies that if you stay informed and react quickly, you'll be safe. But that story quietly breaks down when markets stop being arenas for price discovery and start becoming battlegrounds for control. Silver crossed that line a long time ago, and the consequences of that shift are now surfacing in ways that confuse almost everyone watching the chart. Here's the false comfort people cling to. They see a violent drop in silver, a sudden crash that wipes out weeks or months of gains, and they assume something fundamental changed. Maybe demand collapsed, maybe the economy slowed, maybe a policy decision spooked investors. And when silver rebounds just as fast, they tell themselves it was an overreaction, a temporary panic that corrected itself. That explanation sounds reasonable. It keeps the world feeling rational, but it doesn't explain why the same pattern keeps repeating, why crashes are so precise, why rebounds are so immediate, or why physical silver becomes harder to find exactly when paper prices say it should be cheap. To understand that contradiction, you have to let go of the idea that silver is one market. It isn't. It's two markets wearing the same name. One is a paper market, where contracts, futures, and algorithms determine a number on a screen. The other is a physical market, where metal is mined, refined, shipped, stored, and consumed. Most of the time, those two markets stay loosely connected, and the illusion of a single price holds. But when incentives diverge, when power concentrates, and when control becomes the goal instead of profit alone, those markets start pulling in opposite directions. This is where one early mechanism matters more than almost anything else. Paper silver can be created in virtually unlimited quantities. Physical silver cannot. That difference sounds obvious, almost boring, until you realize what it allows powerful players to do. If you can sell paper claims faster than physical metal can be delivered, you can push prices wherever you want in the short term. You can create the appearance of abundance even as real supply tightens. And if you're large enough, disciplined enough, and patient enough, you can use that paper pressure to accumulate real metal at prices that don't reflect actual scarcity. For years, this mechanism favored the same dominant force. A single institution sat at the center of the silver paper market, shaping price behavior through sheer scale. It wasn't subtle. Rallies were capped, breakouts failed, optimism was punished. Many investors eventually internalized the lesson that silver never truly runs, that every surge is temporary, and that fighting the system is pointless. That belief became another form of control, a psychological boundary that kept participation shallow and conviction weak. But something changed, and it didn't change loudly. It didn't come with a press release or a televised announcement. It changed quietly, through positioning, through accumulation, through behavior that only shows up if you know where to look. The same entity that once benefited most from falling prices began preparing for rising ones. Shorts were reduced, exposure flipped, dips stopped being threats and started becoming opportunities. And when silver experienced one of its sharpest recent collapses, that collapse didn't represent failure, it represented harvesting. This is the part most people miss. Crashes don't always mean loss. Sometimes they mean transfer. When prices fall violently without a corresponding improvement in supply, someone is absorbing that pressure. Someone is buying what others are forced to sell. And when those crashes hit levels that seem almost surgically precise, levels that trigger liquidations, margin calls, and panic all at once, it's worth asking whether the move was accidental or engineered. Now layer another force onto this picture, one that doesn't care about paper prices at all. While the paper market focuses on leverage, liquidity, and short-term positioning, a separate accumulation has been happening in the physical world. It hasn't been loud either. It hasn't relied on hype. It's been systematic, patient, and state-directed. Silver has been moving east, not because it's cheap on a screen, but because it's essential in reality. Silver isn't just a monetary metal. It's an industrial input embedded in modern life. Electronics, energy infrastructure, medical technology, communications, and defense systems all depend on it. When a manufacturing superpower looks at silver, it doesn't see a trade. It sees a bottleneck. It sees vulnerability. And when that same power looks at a global system built on promises, debt, and currency expansion, It also sees insurance. This creates a delayed risk most observers don't want to think about. If one side controls the paper price but ultimately needs physical metal, and the other side is draining physical supply while ignoring paper signals, the system can function only as long as physical remains available. The moment availability tightens enough, the paper price loses its authority, not gradually, but suddenly. History doesn't repeat in identical ways, but it does repeat in structure. Whenever claims multiply faster than the underlying asset, confidence becomes the real currency holding everything together. As long as participants believe delivery will be honored, the system survives. When that belief wavers, behavior changes fast. Requests increase. Hoarding begins. Trust collapses before defaults are ever announced. Right now, you can see early signs of that stress without looking at a single chart. Inventories shrink. Premiums rise. Delivery patterns change. Physical buyers pay prices that make no sense if you believe the paper number tells the whole story. And the most important players are not reacting emotionally. They're positioning calmly, absorbing volatility, and letting others exhaust themselves trying to trade noise. This is not a story about good and evil or heroes and villains. It's a story about incentives. One side needs time to finish building a position before reality asserts itself. The other needs metal before access becomes constrained. Both understand that the end state looks very different from the present, and both are acting accordingly, even if their strategies appear contradictory on the surface. The uncomfortable question, and the one we'll continue with next, is what happens when the paper market is forced to reconcile with the physical world, not through opinion or analysis, but through necessity. When metal leaves the system faster than confidence can replace it, the rules change, and the people still relying on old assumptions are usually the last to realize it. Stability doesn't collapse all at once. It thins, it stretches. It starts relying on belief instead of substance. And once you see that happening, you can't unsee it. The silver market today is held together less by metal and more by trust in a system that assumes metal will always be there when needed. That assumption is the pressure point. Let's move away from feelings for a moment and talk about structure, because structure reveals intent. The paper-silver market is centered on futures exchanges where contracts represent promises of delivery at some future date. Most of those contracts never result in metal changing hands. They're closed out, rolled over, or settled in cash. That's not a flaw. That's how the system is designed to function under normal conditions. Liquidity depends on it. Volume depends on it. Price discovery depends on the idea that delivery is possible, not that it's common. The problem begins when delivery stops being rare and starts becoming strategic. When large holders choose metal over cash, they change the math for everyone else. Each ounce that leaves the vault reduces the buffer that supports all remaining claims. And that wouldn't matter much if supply were abundant. But silver supply isn't elastic. Mines can't ramp production overnight. Recycling responds slowly. Above-ground stockpiles are finite, and much of them are already spoken for by industry. Over the last several years, visible silver inventories tied to Western exchanges have been shrinking, not drifting lower, not oscillating, but draining. What once looked like a deep reservoir now looks more like a narrow channel, and every month more metal leaves than enters. This isn't speculation, it's observable movement. Trucks get loaded, vault balances decline, registered categories thin out. These aren't abstract numbers. They represent real bars removed from circulation. Now ask yourself who benefits from that drain. It isn't retail investors buying a few coins. The scale doesn't match. It isn't industrial users alone, because their demand is relatively predictable. The persistent pressure comes from buyers who don't flinch at premiums, who don't wait for pullbacks, and who don't care what the paper price says. That behavior points to entities whose objectives are not short-term profit, but long-term control and security. At the same time, the paper price behaves in ways that feel almost theatrical. Rallies approach technical resistance and fail. Sudden sell-offs cascade through stop-loss levels. Margin requirements change at moments of peak stress. These events are often explained as risk management or volatility control, but their effects are always the same. Weak hands are forced out, leverage is punished, those without deep pockets are removed from the field. Here's where second-order effects start to matter. When repeated volatility trains participants to expect failure, participation shrinks. Fewer long-term holders remain willing to weather drawdowns. Liquidity becomes more concentrated in the hands of players who can survive turbulence. That concentration makes future price control easier, not harder. Volatility becomes a tool, not a side effect. There's also a geopolitical layer that rarely gets discussed openly. When a nation decides that certain materials are strategic, it doesn't announce every move. It adjusts policy quietly. Export rules tighten. Licensing requirements appear. Trade flows reroute. From the outside, it looks like bureaucracy. From the inside, it's preparation. Silver's inclusion in strategic material planning signals that it's no longer viewed as just another commodity. It's viewed as infrastructure. And infrastructure is never left to chance. If access might be threatened in the future, accumulation happens in advance. If supply chains might be disrupted, redundancy is built early. That's not paranoia, that's planning. The same logic applies to monetary hedging. When reserves are concentrated in a currency undergoing constant expansion, diversification into tangible assets becomes rational, not ideological. This brings us to a tension that can't be resolved smoothly. One side of the market needs paper credibility to hold until positioning is complete. The other side is indifferent to paper credibility and is focused on ownership. These strategies can coexist only temporarily. They are not aligned. They are passing each other in opposite directions. Watch what happens when these forces intersect. Physical premiums begin to decouple from futures prices. A gap opens that shouldn't exist in a perfectly arbitraged world. In theory, traders should buy cheap paper silver, take delivery, and sell it where prices are higher. In practice, that process breaks down when delivery becomes constrained, delayed, or discouraged. Arbitrage requires trust. When trust weakens, price gaps persist. This is why you can see silver quoted at one price on an exchange and sold at dramatically higher prices elsewhere. It's not inefficiency, it's fragmentation. The market is telling you that silver is no longer one thing. It's a promise in one place and a possession in another. And those two forms are diverging in value. There's another signal hiding in plain sight. Delivery demand patterns have changed. Historically, most contracts expired quietly. Now, more stand for delivery. The names behind those deliveries aren't public, but the consistency and size suggest institutional intent. This isn't curiosity, it's strategy. Each delivery request tests the system. Each fulfilled request reduces future flexibility. Meanwhile, coordinated actions by exchanges amplify stress exactly when it's most effective. Margin hikes force liquidation at the worst possible time. They don't affect players with unlimited capital or those operating outside the margin system entirely. They affect everyone else. This isn't conspiracy, it's mechanics. Rules impact participants differently based on scale. So, who's winning? The honest answer depends on the time frame. In the immediate sense, price control still belongs to the paper market. Volatility can be manufactured, sentiment can be shaken, charts can be bent to will, but control of price is not the same as control of supply. And control of supply is what matters when confidence erodes. The deeper issue is that this system relies on a shared agreement that delivery is optional, not expected. The moment enough participants decide they want the option exercised, the entire structure strains. And strain doesn't announce itself politely. It shows up as delays, excuses, rule changes, and eventually repricing. This is the cliff we're approaching, even if we're not there yet. The drain continues, the gap widens. The behavior of the largest players reveals their expectations. They are not positioned for stagnation, they are positioned for resolution, and resolution, when it comes, rarely arrives gently. The question that hangs in the air, and that leads us forward, is not whether this imbalance exists. It's how long it can be managed before reality forces a reconciliation. And when that reconciliation begins, it won't ask permission from charts, analysts, or narratives built on past behavior. By the time a system is forced to reconcile with reality, most people are already positioned for a world that no longer exists. That's the quiet cruelty of structural change. It doesn't punish ignorance first, it punishes outdated confidence. And in the silver market, confidence is still anchored to assumptions that were valid when physical abundance was taken for granted and when paper claims rarely competed with real demand. Here's the practical reframe most people never make. Price is not truth. Price is permission. It tells you what the dominant system currently allows, not what underlying reality requires. When paper markets are liquid and trusted, price permission feels absolute. But when physical constraints tighten, price becomes negotiable, conditional, and eventually irrelevant. That transition doesn't happen overnight. It happens through hesitation, through delays, through rules being rewritten in ways that seem technical but feel increasingly arbitrary. Think about how confidence actually fails. It doesn't vanish because someone announces a crisis. It fades when people notice that behavior no longer matches incentives, when large players stop reacting to price drops with fear and start treating them as scheduled events. When physical buyers ignore dips entirely and continue accumulating. When volatility stops flushing out demand and starts attracting it. Those are not bullish signals in the traditional sense. They're signals that the market is no longer governed by the same logic. This is why the recent violent moves matter less than how they're being used. A sharp crash doesn't scare institutions that understand the mechanics. It helps them. It transfers metal from weaker hands to stronger ones. It conditions observers to expect instability. And it creates a psychological ceiling that delays broader participation. All of that buys time. Time to accumulate, time to prepare, time to finish positioning before repricing becomes unavoidable. At the same time, physical reality keeps asserting itself quietly. Industrial demand doesn't pause because futures dipped. Strategic accumulation doesn't slow because charts look ugly. Vaults don't refill themselves because sentiment improves. Once metal leaves circulation, replacing it requires effort, time, and higher prices. That's the asymmetry paper markets can't escape. They can suppress perception, but they can't manufacture atoms. Historically, systems like this don't end with a smooth adjustment. They end with thresholds being crossed. Sometimes it's a delivery failure that forces cash settlement where metal was expected. Sometimes it's an exchange rule change that exposes desperation instead of confidence. Sometimes it's a sudden repricing that skips levels entirely, leaving participants disoriented and angry. The common thread is surprise, not because the warning signs weren't there, but because most people were watching the wrong indicators. Notice what's missing from the behavior of the largest players. There's no rush, no urgency to talk prices higher, no need to convince the public. That silence is telling. When accumulation is the goal, attention is a liability. When the end game is approaching, patience becomes more valuable than persuasion. Those closest to the structure understand that once confidence breaks, it can't be patched. It can only be replaced with a new equilibrium. That's why paper volatility will likely continue right up until it doesn't matter anymore. There will be more sharp drops, more sudden rallies, more explanations that sound plausible but fail to connect the dots. Each move will feel like a reason to act, to trade, to react emotionally, and each reaction will benefit those who already understand the outcome and are simply managing the path toward it. The mental model that helps here is simple but uncomfortable. Ask not whether silver should be higher, but who needs it lower right now. Ask not why demand isn't reflected in price, but where demand is being satisfied off exchange. Ask not whether manipulation exists, but whether incentives align for it to continue indefinitely. When those questions start producing contradictory answers, you're looking at a system nearing transition. None of this requires predicting a date or a trigger. Systems rarely fail on schedule. They fail when pressure exceeds tolerance. That tolerance is shaped by inventory, trust, and alternatives. As inventories shrink, trust has to work harder. As trust weakens, alternatives gain appeal. And when alternatives become more attractive than compliance, behavior changes quickly. The unsettling part is that by the time resolution becomes obvious, it's usually too late to adjust without cost. Prices don't climb politely. They gap. Access tightens. Rules favor those already positioned. And narratives shift to justify outcomes that were previously dismissed as impossible. The same voices that once mocked the idea of scarcity will explain why repricing was inevitable. This is why the most important question isn't where silver trades next week or next month. It's whether you're anchored to a number or to an understanding. Numbers change. Structures persist until they break. Understanding lets you see when confidence is being maintained artificially and when it's being quietly abandoned by those who matter most. As this situation continues to unfold, pay less attention to declarations and more attention to behavior. Watch who accumulates during weakness. Watch who ignores price signals entirely. Watch how rules change under stress. And watch how explanations evolve when old logic stops working. Those shifts tell you far more than any forecast. In the end, silver isn't the story. It's the signal. A signal about how modern markets function when promises multiply faster than resources, when power concentrates, and when confidence becomes the final backing of value. Whether this resolves through repricing, restructuring, or something messier is almost beside the point. The process itself reveals how fragile certainty really is. So here's the question to sit with, the one that doesn't offer comfort or closure. If the price you see is maintained by belief, leverage, and time, and the asset beneath it is being steadily removed from the system, which of those do you think runs out first?